As expected, the Bank of Canada has lowered its overnight rate by 0.25%, its third consecutive cut. Joining me now to discuss is Elaine Lindhorst of TD Asset Management. And Elaine, did anything surprise you today?
No, Anthony, no surprises. As you said, this was fully priced in by the market, but more importantly, the data supported this cut. When you consider inflation in Canada, in July, our rate was 2.5%. That's firmly within the Bank of Canada's target range, and it's the 7th reading we've had there. So when you consider 2 years ago, summer of 2022, we had 8% inflation. That's firmly behind us at this point, and those high interest rates that we have had here in Canada are no longer warranted.
Okay, now we've seen 3 rate cuts. Do you think the Bank of Canada has to pause at this point, or will we see more cuts further down the road?
So no pauses in sight, and I'll tell you why. There's really, when you consider the data, it doesn't support pausing at this point. So inflation within target, and actually when you break inflation down further and you take out mortgage costs, which are arguably driven by higher interest rates, we're actually below that target range of the Bank of Canada. Unemployment data has weakened, so we're almost 2% higher unemployment here in Canada than we were at the beginning when the Bank of Canada started raising interest rates. So we're at 6.4%. And when you consider that, historically it's not a high rate, but 1.5 million Canadians roughly have lost their jobs. So a weakening of labor. And then economic growth. It is not robust in Canada. It is positive, but not robust. And then when you further break down economic data, you consider it on a per capita basis. So how much is each person producing? We've actually lost multiple percent of growth there since the Bank of Canada started hiking.
And how are money markets pricing in moves in the Bank of Canada's overnight rate for the rest of the year?
So looking forward, the Bank of Canada's next scheduled meetings are in October, December, and January. At each of those meetings, a 0.25% cut is priced in. Then if you go further to the end of July of next year, it's actually almost six cuts priced in. So we're looking at an overnight interest rate closer to 3% in 2025.
Okay, now currently markets are pricing in a Fed cut in September. Do you see this reducing the downward pressure on the Canadian dollar and more importantly, easing the risk of importing price inflation here in Canada?
Yes, absolutely. So when you think of our overnight rate now, we're roughly 1% below the US overnight rate. And historically, since the great financial crisis, that's really the maximum. It's roughly the maximum that we have been. And if the Fed had not changed their rhetoric and did not start to cut interest rates, then yes, we would have expected an impact from that.
Okay, talk a little bit about the risks for the Bank of Canada, particularly housing market. Do you see, is there a risk that the housing market could heat up after this third cut?
So at this point, no signs of reacceleration in the housing market here in Canada. And over the near term, we would expect that to continue. Kind of 2 key points. First of all, immigration has been extremely strong in Canada. And when you consider immigration, arguably that is a strong supporter of the housing market. Second is resets of mortgage rates. So when you consider the Canadian economy, the bulk of Canadians have not reset their mortgages yet. And that wall of resets should occur spring of next year. So that at that point, Canadians will be looking at mortgage rates that are, multiple percent higher than they are currently. And that will also work to contain the housing market.
Looking ahead, what are the indicators you'll be watching closely as the Bank of Canada considers its next move?
So I would say that we're focused on the downside risks. When you consider inflation, those high inflation prints are in the past at this point. So it's really about the labor market. Does it hold out? It's about the economic growth in Canada. How does that work out? And lastly, obviously our US partners, because the United States continues to be our predominant trading partner. So how they fare will affect our economy as well. So lots to watch and stay tuned.